Okay, so we're good to go?
Yeah. Yeah.
All right.
Ready?
Okay, well, thanks to, first off, thanks to David and Anka for the this Friendsgiving event. I really do appreciate the invite. I know it's going to be a great week here with lots of good speakers providing a lot of valuable education, I'm sure, for all markets and time frames, regardless of what you trade. That's what I'm here to do today. My name is Silas Peters from Seasonal Swing Trader, and I am going to show you a very mechanical strategy that can be used across any market, any time frame. In fact, everything that I teach can be used for any market, any time frame. I don't limit you to any particular asset class or time. So this strategy is very unique, and it actually works, and it uses price action. So I'm going to be teaching you this methodology, and I know I do have a limited amount of time, so I want to make sure I get through all the meat, the educational components of it. Hopefully we have a few minutes in the end. I can answer any questions, and you can always reach out to me if I do miss you, if you think of something later, and I will reply to you personally. So let's go ahead and get started here. You are here to see how I'm profiting off of the waves of the market. So let's go ahead and get started. Do want to say welcome. Thank you for your time. I know everybody's busy, especially coming in to the holidays here if you're celebrating. So it's a very hectic time. In fact, it seems like every week is hectic now. So you being here shows me that you are willing to make an effort to learn up and master a strategy that can help excel you in your trading. First off, we must begin with the risk disclaimer as required by the regulatory governing bodies. Past performance is not necessarily indicative of future results. Only risk capital should be used to trade. We know that you should not trade money which you cannot afford to lose. Trading is risky. Always consult with your financial or tax advisor before applying real funds in the market. Now is the time you want to shut everything down. Remove all of your distractions. That means closing browser tabs, logging out of Facebook, Snapchat, TikTok, Instagram, whatever it is. Put your phone on mute. Hush your crying baby. We are going to be together for about 50 minutes or so, and I want to make sure you listen closely and take good notes. Before we begin, let me formally introduce myself. Simply put, I'm a husband, father, son. I love hanging out with my family, whether it be at the beach, on a boat, hiking, or on the golf course. I spend a lot of time working, a lot of time in front of the screen. So I like to get outside and enjoy the great outdoors when I can. So these are just some pictures here of my family, and I show you that I am a real human being, not a robot, probably just like you. You've got my dog here photo bombing my two girls there on the boat. But how did I get here? Get to where I have the privilege of speaking to you today. Well, in college, I majored in investment finance and economics. That's all good and great, but I had no idea where that was going to send or land me. Fortunately, I was playing golf one day, and one of my dad's golfing buddies used to be an ex-wheat trader in the grain pits of Chicago. So we were playing, and he was asking me about my plans, what I was going to do, and embarrassingly enough, I had no idea. To say I have no idea. Well, he was telling me about his experience there on the floor, commodities, trading, Chicago, everything. I was immediately intrigued. So what happened? I started doing some research on Chicago, the trading floors, commodities, all things trading when I went back to school. Then what happened? Well, needless to say, I was a bit green on the sleeve when I sold my car 3 days after graduation, rented a U-Haul truck, and I drove to my new digs in downtown Chicago, right here, signing a lease in a tiny studio unit on the 23rd floor of Marina City, or also known as the Honeycomb Towers, overlooking the beautiful Chicago River. Really great experience here. Had Smith & Wollensky's down here, House of Blues down the bottom beneath me, and then back a block or so, I think I had Harry Carey's. So a really exciting time here. And actually the same day I moved in, I took the U-Haul back to this depot, and I hopped on an Amtrak train and scalped a couple of tickets to watch the US Open at Olympia Fields to chase Tiger and Phil around. But back to my journey, or my career path, if you will, my first career until this. And I want you to picture this. I was working the Asian, European, and early New York session trade desk. So if you remember me telling you I sold my car, well, this picture right here could literally be me walking to work at some time around 6 p.m., 2 a.m., or if I got off early, maybe even 6 a.m. And I remember on numerous occasions me walking down the middle of LaSalle Street, nobody but me and a snowblower in the entire city of Chicago, walking down LaSalle Street, looking at the Great Board of Trade with the God of Grains or Ceres looking down upon me, walking into the Board of Trade and the temperature reading a solid negative something degrees Fahrenheit. And remember, I am from deep South Alabama here on the Gulf Coast. So if we got into the teens, it was like a heat wave coming through. So I did this right here for a few years, working at the Board of Trade, handling some serious trade size across the Board of Trade, Merck, NIBOT, NYMEX, and various London and Asian exchanges, trading for a hedge fund, banks, other CTAs, everything from corn to copper to hogs, euro dollars, Japanese government bonds. It was an incredible learning experience, both with the markets and trading, as well as the Chicago big city life. But I decided to head back south when some other opportunities opened up. And that's when I like to say when I went truly corporate. I went from a fast-paced and somewhat stressful hedge fund trade desk to a more slower-paced life, managing equity and fixed income portfolios and other investment management roles in this glass building right here. But to me, it was extremely boring, but it was the safe route. But I missed the action and the excitement of the pits, the tape, and the screens. So through some additional contacts, I was led to a day trading firm where I helped run operations, execution, and trading education, to then running a couple of futures brokerage firms, and then ultimately working in a private family office, serving ultra high net worth individuals, doing a hodgepodge of all these items here. So it's safe to say I've seen a lot of the spectrum in the finance world, but honestly, I was just not that happy. I still miss trading in the trading world. Me sitting in an office, tied to a desk, looking out the window, and of course, dealing with your typical corporate red tape was just not in my blood. I'm not a sit around the cooler, shoot the you know what type of person. I wanted to get back to the markets, to the charts, to the trading. And while I was still trading during this time, I truly missed being in the weeds of the markets, following the charts, doing the analysis, and so on. So I left the corporate world and I started Seasonal Swing Trader. And it's here where I publish research, ideas, and analysis to my followers, and it holds myself and our community accountable each and every day. But during this entire journey, there were certainly some painful lessons to be learned. I grew accounts, blew accounts, grew accounts, blew accounts. I was not a trading god. I was not above the market. The market didn't care what my position was, and it damn sure didn't care about my opinion or what I thought it should do. So what does this mean? It meant blowing accounts, emotional trading, acting like a gunslinger, poor risk management. But these are all battle scars. And in this workshop, I'm going to attempt to help you think smart, think logical, with a proven price action strategy and plan, so you can avoid the many mistakes that I, and I'm sure several of you have made or are making today. But let's talk about you. Why are you here? You're here to have a reliable pattern for all market conditions, to have a strategy for all asset classes, and to be agnostic of market bias. Because in today's markets, it's imperative to make certain we have a strategy that can trade both ways. You need to employ strategies that can profit during up markets, down markets, and sideways markets, and do also without guessing. So today, I'm going to show you a pattern that results in trend reversals, show you the point where a trend is likely to reverse, and show you a pattern with the least risk and highest reward. So does everybody want to see this? Is everybody ready to go? Because we're going to go ahead and get right to it. All right, great. So not only are you going to learn a strategy that is low risk, high reward, but it also works in all markets, all timeframes, all asset classes, conditions, and styles. Like I said earlier, I'm not going to sit here and teach you a strategy that only works on a 1-minute Bitcoin chart or a weekly Facebook chart or a 4-hour crude chart. I want to show you a simple and straightforward strategy that works in any market, any condition, whether it's ranging, consolidation, contraction, expansion, low vol, high vol. I don't care if you're a tick trader, scalper, day trader, swing, position trader. If you trade the underlying, you trade call options, put options, debit, credit spreads, or iron condors or butterflies, I don't really care. What I'm going to show you is powerful, and I'm actually going to prove it to you. Before we continue, it's very important that we cover the process. Has anyone here heard of Jesse Livermore? If not, I encourage you to pick up a copy of Reminiscences of a Stock Operator if you ever get the chance to do so. It's almost like required reading by traders and investors. The question often received is, What do you think about the markets here, Silas? And my typical response is, I don't know, and I really don't care. And I know that sounds harsh, maybe it sounds ill-informed, especially when asked by friends or family members, but it's true. For the most part, I really don't care about the daily news that flow in and out of the market. I'm a trader that trades strategies based off probabilities. So we want to forget about market assumptions and only focus and trade with high probability strategies and what is in front of us, which means no more predicting. So successful traders possess three common traits. We must realize that knowing what is going on in the news and knowing how to make money consistently are two separate things. And for successful traders, it's about your strategy, your logic, and your process. It doesn't matter what you think the market is going to do tomorrow. And I realize that's a difficult concept for maybe new traders to understand and even seasoned traders. I certainly want to form my own opinion as well because it's just human nature. And it took me years to figure this out. See, it doesn't pay for me or you to try to absorb every financial story out there or slap every indicator onto a chart. All I care about is when the markets I'm following reach key criteria. But there is one more trait, because if we allow probabilities and not talking heads to define our next move, we need to really possess and control one more trait, and that is patience. Because we as smart traders know that trades should never be forced, because a forced trade is not a statistically sound trade. Again, we are in this for the long game, and patience is expected if you wish to bring in profits over the long term. So this may sound boring to the aggressive crowd out there, but I'm more interested in the profitable trades, not trying to be the short-term hero who tries to trade every scenario out there. I'm confident in trades that consist of key criteria that are setting up, and we're talking about extremely high probability trades. But patience is the key ingredient to the success of this strategy and really any strategies that you may wish to employ. So what is a high probability strategy? It's one that requires patience coupled with a disciplined approach. Waiting for the appropriate scenario to unfold with a high probability of success is what makes this strategy a success. It also recognizes that opportunities are made up easier than losses. So if we let a few pass us by, we don't dwell on what could have been. There's always going to be more opportunities around the corner. Because lastly, I realized that the less I trade, the better my strategy will likely perform over the long term. And the long term is what matters. This likelihood is what makes my high probability strategy unique and successful. But the grand takeaway here is patience pays in this game we call trading. So, Silas, what indicators do I use to successfully trade high probability strategies? What's the secret sauce? What are the ingredients? Well, we talked about one being patience, but I learned early on to keep it simple. Pick an indicator or two or three and try to follow them forever. I can't tell you how many traders that I know want to follow. They send me charts with Donchian channels, market profile, Gann, Bollinger Bands, fib retracements, all on one chart. Can't even read the price action. And I'm not knocking that, I'm not saying that's wrong. But this high probability strategy uses price action alone, plus one very common and free indicator, along with a couple of pro tips to take advantage of sentiment and technical extremes. Has anyone here seen Jerry Maguire? Let me know if you've seen this movie, Jerry Maguire. Love it or hate it, this is a famous line. I'm not going to jump up and down on my desk and annoy you, because I really can't show you the money because I don't know how you trade. But I will show you the opportunity. So let's get right to it. It is divergence. Wow, what a brand new concept, right? Oh, of course not. Who here has heard of divergence? Divergence has been around for, I don't know, since the beginning of charting time. And that's fine. But I encourage you to stick around to show you how I use it with a little bit of special sauce, whether you've heard of this or whether you have not. Let's quickly talk about it. We're going to dive into several examples. Divergence is when the price of an asset is moving in the opposite direction of a technical indicator, such as an oscillator, or moving contrary to other data. Divergence warns us that the current price trend may be weakening and in some cases may lead to the price changing direction. So basically, it's an indicator in price action being in disagreement using any relevant indicator such as MACD, RSI, and it's an indication of a reversal or a continuation, but more often a reversal. What is it? It can occur between the price of an asset and almost any technical or fundamental indicator or data, and is typically used by traders when the price is moving in the opposite direction of a technical indicator. The details. Positive divergence is when price is moving lower, but a technical indicator is moving higher or showing bullish signals. Negative divergence occurs when the price is moving higher, but a technical indicator is moving lower or showing bearish signals. Why is it important? Because it's the earliest indication of a reversal, usually a good sign to exit, a good sign to scale. It means that we're usually buying near the bottom or selling near the top. Hint, hint, this means the risk on our trades are very small relative to our potential reward. So types of divergences, let's quickly talk about these. We have classic divergences, sometimes called regular, bullish, and bearish. Bullish div is when price action makes a flat bottom or lower low and higher low on your oscillator. Bearish divergence when price action makes a flat top or higher high and lower high on your oscillator. Traders use divergence to assess the underlying momentum on the price of an asset and for assessing the likelihood of a price reversal. So if the market's making new highs, but let's say the RSI starts making lower highs, this warns us the price of the uptrend may be weakening. This is what we call negative divergence. Positive divergence is the opposite situation. Imagine the price of your stock making new lows, but the RSI is making higher lows with each swing in the stock price. Traders would then conclude that the lower lows and the stock price is losing its downward momentum, and a trend reversal may soon follow. Let's look at this here. An example of regular bullish divergence. It's the most frequent and usually considered a sign of a reversal. So if the price is making lower lows, we have low, lower low, but our oscillator is making higher lows, low, higher low. That's bullish divergence. We don't need a series of lower lows. We only need one low to be lower than the previous low, and this can usually be found near bottoms. Regular bearish, again, the most frequent, usually considered a sign of a trend reversal. Price is making higher highs. Here we have high, higher high, but our oscillator down here, high, lower high. This is bearish divergence and can be found near tops. Now let's talk about identifying trend strength and consider the following scheme. Here at point 1, right here, buyers believe that the trend either has recovered or a new trend has begun and they want to make money. So they start buying up the market, opening long positions, accelerating the price higher. The trend continues as more and more buyers are jumping into the market. At point 2, buyers are starting to take profits, but they calm down a bit because they're afraid that the trend may be coming to an end. Trend is weakening. Now, at point 3, there's no more buyers in the market. Sellers step in and they begin to dominate the buyers and the trend reverses. Okay. So we can use tools to help recognize trend and trend strength. And one of those can be found with the popular RSI indicator found on every platform. I believe the standard rule of thumb, if you will, is when the RSI rises above 70, the market's considered to be overbought. When the RSI falls below 30, the market's considered to be oversold. It's a great concept, but we're going to use the RSI in a slightly different way. Look at the same chart. There's 2 significant highs labeled A and B on the price chart. And in the corresponding pane below, we have an A and a B. In the price chart, we see that B is higher than A. That means the price is going higher. In the RSI pane below, we see that B is lower than A. This means the trend is weakened and is likely going to reverse. And lo and behold, what happened? Market sold off reversed, and it reversed hard to the downside. Now, we use the RSI in the previous example, but it can be replaced with any indicator, such as CCI, stochastics, MACD, and so forth. All of these indicators are derived from price, so there are no better or worse indicators. It's really about preference. It doesn't matter which one of these you call your best friend. All approaches are equally good, but let's get back and focus on what matters, which is the concept of divergence. So let's quickly recap here for context before we take a deeper dive. Bullish div is when price makes two significant lows, but the second is lower, and the RSI makes two significant lows, but the second is higher. Bearish div is when price makes two significant highs, but the second is higher, and the RSI makes two significant highs, but the second is lower. Now, we previously defined divergence as a discrepancy between price and indicator movement. Note that we've now added the MACD to the chart. So when the price makes a new low, right here, we have a low and a new lower low, but the MACD makes a higher low. We have a low, higher low. We have MACD divergence, bullish divergence, signaling that the trend is likely to reverse. This is classic or regular. The black line on the price chart here is sloping down, but the black line on the MACD is sloping up. So the depth of the divergence is a bit more of a subjective term. When you look at this example, we see two div patterns, a bullish and a bearish. The first divergence is nice, but the second one does not look as promising because the two peaks or troughs on the MACD are not very significant. We consider a divergence to be deep if the MACD crosses the zero line. Such a divergence provides a much stronger signal for trend reversal. So if we look at this chart here, we see two div patterns. The first example right here, as we can see, is an almost double bottom pattern, if you will. The second example has more defined peaking action. When we peak right here, we peak. Notice that the MACD now crosses the zero line, rises back up, forms a second peak, which is lower than the first, thus giving us our divergence pattern. And because it did cross the zero line, it means that we have a higher quality divergence pattern. So now we know the basics of divergence. Let's look at ways we can approach them in a smart and methodical manner. As we discovered, these patterns can lead to consolidation, correction, or full trend reversals. And that's great, but we need to know where to enter, where to place risk, and where to exit for profits. Because with this strategy, you can make quick profits on small corrections or minor trend reversals, or try and capture major market moves. And when the trend reverses, it's every trader's goal to try and stay with the trend for as long as possible. So we now know that divergence is a very reliable pattern. Sometimes chart pattern traders see a double top pattern. Elliott wave traders may see a shortened fifth wave, but they all refer to the same thing, the divergence pattern. So this is what chart pattern traders see, double top. It's what Elliott wave traders see, shortened fifth wave. And this is what we see right here. Most traders don't realize that MACD or RSI divergence is exactly what they are looking for. Our approach removes the subjectivity because the div pattern is well defined. So now let's talk about entry. Let's look at this into even greater detail with some charts. The first is entry. Where or how do we even enter these trades? There's a couple of different ways we can consider entries, and that is one, a simple enter on next candle open concept. So we wait for the div candle to close, and then we enter on the next bar or candle open. Another method is to wait for candlestick confirmation. That's where we wait for a bearish candlestick, either some type of engulfing or reversal candle for short positions right here, or a bullish candle or bullish engulfing reversal for long positions. Okay. So now we talked entry. we need to talk about the least fun or exciting aspect of trading, but by far the most important, and that is stop losses or risk management. One could argue all day the best place to put a stop loss, but we want to keep things simple and objective. So for a stop loss with this strategy, we can place it just below the bullish divergence pattern for a long, or just above the bearish divergence pattern for a short. So here we have our divergence pattern right here, and we get a bearish reversal candle. Gives us confidence to take a trade to the downside. Here we have a bullish divergence pattern followed by a bullish pin bar to take a trade to the long side. We want to place our stop above the high of the entry candle plus a couple of ticks, pips, or points, and minus a couple of ticks, pips, or points for a long. We'll talk about this later in greater detail. So in this example here, we see the second turning point, or the point of divergence, acts as minor resistance from which price uses to retrace. And we are thus protected from being stopped out too soon. So we've covered entry, we've covered stops. Now let's get to the fun part of trading, and that is profit targets. Remember, our first goal is to make a profit before the market turns against us. We don't need to shoot for the moon here, so we don't place the first profit targets too far. I have found in my trading and back testing a wise place to place the profit targets are at significant areas of support and resistance, or what I like to call price structure. This keeps us from guessing an arbitrary amount of ticks or points. The divergence valley is a good place for profit taking. Notice that we have very clear price structure at these levels, and price is likely to gravitate towards these areas like a magnet. It is no coincidence that prices have a reaction at these levels. So by taking profits here, we can profit from div patterns that result in minor trend changes or corrections, and we can make consistent profits based on this exit technique alone. But divergence, as we know, can also lead to complete trend reversals. And we want to take advantage of these huge trends that can occur in the markets, which we'll cover in just a bit. Candles. Again, when we have a candlestick reversal pattern or an opposite divergence pattern that appears, it can serve as a good place to exit. These important reversal patterns can signal that the trend may reverse or at a bare minimum pause. So if we get a candlestick reversal pattern that appears close to our first take profit level, but we were not filled or the objective was not reached, it means that price has simply turned from our structure levels early. We can then simply close a third, half, 2/3 of our position early, move our stops to break even, and let the trade ride. Okay, here is an example. Here is a long example right here. We're looking to buy the market right here. We're working targets up in this area. Notice that we get a bearish reversal candle right near our take profit level. Price retraced a bit, came back up, put in another reversal candle right back to that take profit area again. But this time it drifts all the way to our stop out area. So that is why it's a good idea to consider closing part of our position up here and not getting greedy, holding out for that last few bits of ticks, points, or pips. So another great way to trade the strategy is add a couple moving averages to your chart. It doesn't matter which ones you use, find a couple and see what works best for you. But here I have an 8 EMA, which is the fast EMA in green. And here I have my slow EMA, which is a 34. So I got an 8 and 34 loaded on here. And the first look at this example shows that the candlestick pattern was possibly a solid place exit. Does everybody see that right in the middle of the chart here? Big bullish candle. So we're looking to short up here. First profits are right here, our first targets rather, and then the market trades lower and we get a big candlestick reversal pattern. Hey, and that's great. I'm not complaining. If we're shorting up here and we're having to exit right here, I'm not complaining, but there is room for improvement. When we add that 8 and 34, we may have been stopped out right here, but notice that prices bounced into this EMA, rejected, and we are able to re-enter the market and continue to try the trade lower into profit, all by stair stepping above swing highs along the way. So now you've seen a handful of examples here of how to catch quick moves after divergences, as well as longer position type moves. The most popular approach amongst traders that I see is they exit a certain number of ticks or points or pips. But to me, that's the wrong way. As you know, every market, every time frame have different volatility components. So it makes no sense to go for an arbitrary 100 pips or 5 points on the S&P or $10 on XYZ stock and so on, because volatility changes over time, and it changes over time for each instrument. So the best way to determine your exits is, yeah, you can go test the strategy and learn every market's individual movement or rhythm, but that would take a long time. There's an easier, less objective way. So let's quickly recap some exit strategies that work best for these particular setups. One, structure. Good old-fashioned plain vanilla structure. The valleys and the dips as significant areas of support and resistance. Candlestick patterns. If the candlestick reversal pattern appears close to the first take profit level, but we weren't filled, close half of your position, a third, 2/3, move your stops, and then let the trade ride, or re-enter if you get a reversal type setup. Now I want to cover false divergences. We know that there's going to be false setups, just like there is in any strategy. But how do we help filter these? We know that when traders are trying to jump in a new trend, they likely need some confirmation. And we know that a trend reversal can be confirmed when we have a divergence breakout. And to many traders, that divergence is confirmed when we have minor support or resistance that is broken. So let's take a look at this. There's nothing wrong with this, but with this approach, the entry can be too far away from the start of the move, and the risk can be too high when compared to the profit. Remember, our goal is to limit risk. So this is where we would be looking to get in and looking to take profits right here, as opposed to entering here. Here is where we're looking to buy, as opposed to and take profits up here at this area of structure, as opposed to buying here. This entry technique is not, we're not saying it is wrong, but this is a better way to achieve more consistency with lower risk, because where most traders are looking to enter, we're looking to make a quick profit. I also want to remind you that sometimes the MACD histogram can look choppy, quickly reversing up and down, implying that the market is in a chop zone. And this can generate a long series of false divergent signals. So those of you looking for some holy grail chop zone indicator, you can quick looking. It's called the MACD, and it's located on every single platform. So if you cannot look at a price chart and tell whether it's trending or chop, add the MACD to your chart, and this is how you do it. Chop, trend, chop, trend, chop, trend. Okay, that's all you need to know. Quit looking for a holy grail chop zone indicator. Now, to prevent over trading, I found a way to recognize more clear div patterns. And my golden rule says this, that the signal line must be crossed by two peaks. So you can see chart 1 on the left. You see how the signal line crosses the zero line? Here we peak, crosses the zero line, comes back up, forms our second peak. Chart 2 on the right, there's no crossing of the zero line. We have a peak, 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 and then we cross down here. No crossing of the zero line. So this is going to be your higher probability setup. Does that make sense so far? I'm going to take a quick swig of water. All right, great. Now back to entries. Remember, our goal is to enter as soon as possible after the div pattern has formed. Our strategy gives a signal just after the MACD hook or the turning point. Only after that MACD hook is formed, you'll recognize the second peak on the MACD histogram, and this is where we recommend entering on the next candle open. Okay, a very simple and mechanical rule. Oops. But I further fine-tune this into an even more reliable method, and that's by using simple trend line analysis. I have found that trend lines are a great confirmation tool for this strategy as well as any trading strategy I use. So when we're looking for a long signal, we draw a trend line on the chart by connecting the minor highs, place a buy stop order just above the trend line. When we're looking for a short signal, we draw a trend line on the chart by connecting the minor lows, place a sell stop just below the trend line. When the price breaks the trend line, we are in the trade. This entry is almost the same as the quick entry on the next candle open method, but sometimes it protects us from the false MACD hook when the MACD turns again and continues to fall. And this is maybe a bit more discretionary, but to me, it's the most effective way to enter on divergence signals. Here's another look at a short example. This time to the sell side, we place a small trend line on the chart. We can enter on a sell stop or confirmation retest of that trend line break, and boom, we are in the trade. So now let's recap everything you've learned. You've learned a high probability reversal strategy. You've learned where to enter, where to place risk, where to take profits, and how to filter false setups. But have you ever wondered why the markets turn against you when you jump into a promising looking trend? The most tempting signals are usually a trap. As there are no more buyers to move the market, the sellers dominate. As there are no more sellers to move the market, the buyers dominate. But divergence masters know how to enter in the opposite direction just before a trend turns. And that leads me to this quote I love here by Max Gunther of Zurich Axioms. Yes, following the herd may work sometime. Think of the 90s tech bubble, worked until it didn't. 2000s real estate boom, worked until it didn't. Crypto mania of the 2010s. But do you really want to be the one chasing new highs when you have a high probability of selling them, or panicking at market lows when you could possibly be buying at substantial discounts with much lower risk? Of course you do. That's every trader's goal. But let me tell you, when you trade this way, your winning batting average could be sub 50%. Yes, you do not have to be right 50% of the time, even 40% of the time, when your risk to reward is overwhelmingly skewed in your favor. But here are some additional pearls of wisdom. The less you trade, the more success you will likely have. You want to filter the unreliable div patterns and focus only on the strongest signals. Use a customizable indicator that can deal with this for us, where the process of recognizing the patterns in the chart is done for us automatically. You sit back, enjoy the various exit levels, and find out what suits our trading style the best. But how do you trade it? Well, largely depends on your style of trading. You can scout for quick profits on the 1 minute chart. You can look for on the tick chart, 5 minute. You can look for intermediate trend changes on the 30 minute, the hourly, 4 hour, or do larger swing and position type trading on the daily, weekly, and monthly. Works on any asset class, stocks, futures, currencies, cryptocurrencies. If you can chart tea leaves or tulips, anything that can be charted, this strategy will work. But you've got to be patient. You've got to avoid over trading, because patience pays. And I'll continue to remind you that you've got to be patient in trading. Patient. But how? Silas, too many markets, too many time frames. I just don't have enough time. Believe me, I'm with you. I'm in the same boat. We don't have enough time in the day. Well, we've now developed a time-saving solution so that traders can live their lives, not worrying about scouring through thousands of symbols, dozens of time frames, scrutinizing hundreds of charts, trying to determine if what they are eyeballing is actually divergence or not. We've now cracked the code and we simplified the process. But how? Let me see here who is ready to stand out from the crowd. Let me see who is ready. Take another swig of water here. My post-Vegas vocal cords are running thin. Awesome. Because it is time to automate with the Divergence Dominator Pro. Divergence Dominator Pro is a fully complete, comprehensive trading business in a box solution. So let me quickly guide you through what this package is so you can immediately see how it can benefit you in your trading. starting as early today. What all do you get? It's a great question. I'm glad you're asking. You're going to get the turning point identifier indicator, or what I call the TPI. You're going to get the DD Pro scanner, price action pro trading course, candlestick recognizer guide, the divergent cheat sheet, DD Pro trade journal, and the TPI fast line cheat sheet. That's a lot. That's a mouthful. I'm going to go through all of this. Let's first talk about the TPI indicator. This is an indicator that Auto Plus Divergence Setups scans the market to locate high probability turning points across multiple markets and multiple time frames on your behalf. So let's see what this looks like. Can everybody see this? This is the TPI indicator in action. This is a daily chart of COP or ConocoPhillips. You can see we have our bearish divergence line here with our bearish divergence signal. Another bearish divergence line with our bearish divergence sell signal. Bullish divergence line, bullish divergence buy signal. And we also have the option to include this on the window pane below. You can see these sell signals, and the buy signals. These here, these are your entry points in blue. This is your risk level. This is target 1 and target 2, fully customizable. I'll talk about that momentarily. How about this example in Win Resorts? Weekly chart. For those that like to trade up the weekly charts, bearish weekly divergence signals right here, 3 right here. 3 bearish divergence signal. You can see the bearish divergence line, bearish divergence line, bearish sell signal, bearish sell signal. Here's an example in 15-minute crude oil futures. Same scenario. Again, any market, any time frame. You see we have a bullish divergence line, bullish buy signal, bearish divergence line here, bearish divergence sell signal. Those signals also coming down here on this optional window pane below. So can everybody see that? Now I talked about these levels right here, this entry level, risk level, target 1 and target 2. These can be changed or manipulated by you. How are these determined? Remember, I told you that volatility changes over for every instrument. So if I told my programmers to put an arbitrary, just make the target 5 points, make the risk 3 points, but it makes sense. If I'm switching from Caterpillar stock on a weekly to a chart of lean hogs to a chart of 2-minute Bitcoin, don't you think that the volatility is going to be different for each of those? Of course. So the risk and target levels are based off of an ATR multiplier. So your risk at the ATR is say $2 on, this is actually a 1 hour chart of the pound yen, but let's actually say the ATR is 20 pips on the hourly chart of the pound yen. You're going to put your stop ATR multiply. It's going to be 1.5 times 20. Your take profits here, 1 and 2, going to be 2 times ATR, which is 40, and 3 times ATR here, which is 60. And you always want your profit ATRs to be larger than your stop ATR. So it ensures you have a higher than a 1-to-1 reward versus risk ratio. Okay. All those settings are explained. Now, platforms. How about Thinkorswim, TradeStation, Ninja 8, TradingView, MetaTrader 4, and Wealth Charts? You attach the TPI to your chart, as we just discussed, and immediately begin to see turning points, i.e. divergence, in real time. No repainting. We don't want to locate these manually, do we? If you've been trading for some time, you already know that divergences are probably the most reliable and profitable trade setup for trade and reversals. But here's the thing. Manually identifying these are difficult. They're time consuming, especially when analyzing multiple markets and timeframes. And that's where the TPI comes into play. Automatically detecting the highest probability divergences for you with the click of a button. Combined, the TPI indicator and scanner are capable of identifying these across all asset classes, timeframes, chart types, ideal for scalpers, day traders, swing traders, and position traders. But aside from the indicator and scanner, I really feel like the crown jewel of this package is my Price Action Pro trading course. This is a 10-part on-demand video module. detailing all of the following. This is a full step A to Z training course focused on trading pure price action, how to find and identify the most important areas to even consider being a buyer to seller, completely removing the uncertainty, all by trading in conjunction with the TPI. So, do you want to quit guessing, feel confident about your entries, remove your emotions, think like a professional, scale your reward versus risk, and have a solid trading plan? If the answer is yes, well, you're going to get the indicator for all 6 platforms, the scanner for 3 platforms, but it's very important that I help jumpstart your success even further. Because as I said, divergence is no secret. It's been known and used for decades. But now not only do you get a first of its kind tool, an indicator that locates high probability turning points on your behalf, the Price Action Pro course has all of the solutions to help you with each and every one of these bullet points, and a comprehensive step-by-step on-demand video module course that can be viewed over and over again. I'm also going to throw in the Candlestick Pattern Recognizer Guide. We know that there are dozens of candle patterns, but we're only going to focus on the most important patterns that you should focus on. This can be downloaded and printed off for your desk reference and study, everything from the ins and outs, the structure, how to interpret, and much more. Also going to get the divergence cheat sheet. This is great for those that like written descriptions and summaries, but can also accompany the video modules. We're going to talk about regular div, hidden div, exaggerated div, the differences between each, and much more. So the Divergence Dominator Pro package, again, includes the indicator, the scanner, the PAP trading course, the Candlestick Pattern Recognizer Guide, Divergence cheat sheet, and additional bonuses and resources. But what is all of this worth if you're now able to profit in any market condition? You can anticipate major market reversals. You can trade on your time, regardless of what time frame you trade on. You now had all the tools. You had indicators, scanners, videos, training guides, and VIP email access to me. Yes, I will personally reply to you. This does all of the hard work. You no longer have to guess on where to enter and where to place risk and stop levels. But let's determine if this is a fit for you or not. If you love scalping on nanosecond charts from dusk till dawn, you love to be stressed out and have heart palpitations, you get a thrill of blowing out accounts over and over again and driving to your bank to wire in funds, you have a gambling mindset. You literally have no clue where the market's headed. It's just, let's take a dime out, flip it, and wherever heads or tails, that's where we'll do. We'll either get long or short. This is probably not for you. And if that's the case, no hard feelings. I wish you the best of luck in your trading endeavors. But if you are ready to think like a professional trader, you're ready to remove your gambling mindset, you're ready to get serious and treat trading like a business that it is, and you're ready to kick your emotions, focus, and have confidence on each and every trade, then this could be for you. And if this is for you, I have a very special offer for today's attendees. The package has a $2,000 value just on the indicators alone. The scanners cost another $1,500. The PAP course, the guides, cheat sheets, all that bring the total value to $4,427. But I am very proud of this indicator, the price action course, all of the other educational material. I want to get this out to those that are serious. Those are tired of kicking tires. Those are sick of jumping from system to system. Those that are ready to take action and see real results in their account. So we're not going to charge $4,427. We're not going to charge $3,000. We're not going to charge $2,000, and we're not going to charge $1,000. As part of this live webinar special, we are pleased to offer this to the first 20 signups, a single one-time fee of $397. Yes, you read that right. This is a single one-time fee. You own it for life. The offer link is seasonalswingtrader.com/pro. It's almost 90% off the $4,400 value. You're going to get the indicator suite, the scanner set, PAP course, guides, cheat sheets, a very low one-time fee of $397. I like to cover this very quickly here. I often get asked, Silas, how do you trade these setups? The easy answer is, well, it depends on my setup, my overall outlook, other positions I have on the risk to reward of that particular setup. But how do I physically trade these? How do I physically trade these? Well, I like to trade credit spreads primarily on equities. I also trade credit spreads on commodities as well, commodity futures. I will also trade the underlying on futures and currencies and cryptos as well, and occasionally equities. But let me say that what or how I trade really doesn't matter. Frankly, you should never be concerned with what I'm doing, or Bill or Bob or Susie or Joe. You have a question or idea, shoot it to me. I'll answer you all day long. But in the end, you are in control of your own account, how much capital you have, your knowledge, your risk tolerance, your time that you can personally commit differs from mine. Mine differs from Williams, and so on and so forth. We're all different creatures. You got to find out what works best for you. But I will be here to help answer any questions, struggles, questions, things like that that you have. So here's the offer again. We're running out of time. This is a one-time charge of $397. You do own it for life. Let me quickly get through some questions here. And so this is a one-time fee. This is not a renewal. One-time fee. You do not have to inform me of which platform you're using. You get immediate access to all platforms. They do not repaint. You can use this on binaries. I've seen people use this on binaries as well. I personally don't trade them. How often do the signals appear? That's a great question. Who knows? Depends on the market environment. Depends on the market environment. You suck at technology. Can you help install? I do have a tech guy that can help install. Yes, he can actually do a remote session, log into your computer, help you log in onto one or all 5 platforms if you need so. I do not have a trade room at this time. I want to say thanks to looks like Neil, Brooks, Tim, Brent, BW. Absolutely. Okay, looks like I've got a couple of minutes here. You're welcome. Yes, yeah. If it works on Indian stocks, anything that can be charted, anything that you have access to. Now, the strategy works on regardless of what platform you use, but the indicator, the T.P.I. indicator, works on TOS, Thinkorswim, TradeStation, Ninja 8, TradingView, and MT4, as well as wealth charts. And then the scanner is available for these. We're working on a scanner for WC as we speak. And actually, I do have a secret that even my current DD Pro members do not know. I am just finished a scanner for MT4. I'm kind of working some bugs and tweaks out right now with the developer. And I'm also talking to a programmer that is building out a scanner for TradingView. We're testing this on another product. And then if it's successful, we're going to roll the scanner out, the T.P.I. for TradingView. So I'm super, super excited about that because I love TradingView for my charting. Let me see, one more question. Yes, you can adjust those fast slow lines. Okay, I'm going to wrap it up. Thanks again to David and Anka for having me on the show. Everybody, enjoy the rest of your week. Enjoy the panel of speakers and educators coming through the pipeline. Take care. If you have any questions, you can feel free to reach out, email me. Thanks again for having me on. Take care. We'll see you on the flip side.